Friends, in this video, I am going to talk to you on the topic thinking beyond performance. Most of my investment returns in my career were made betting in places where near-term performance didn't look great, but prospects looked very good, and I invested before others saw the prospects, whether it's in stocks, mutual funds, real estate, gold, anywhere. This overarching principle always applied in all the investing that I have done. When I wore the hat of a professional investor, when I started advising people or giving them some products under the mutual funds distribution or managing a portfolio management scheme, I suddenly started seeing that most of the people whom I interacted with were evaluating what I was suggesting to them on the basis of what that investment had performed in the past. This was completely opposite to how I had done my personal investing for over 3 decades. It continues to be so even now. We are very strongly anchored towards past performance. But as an investor, I am tutored to think exactly the opposite and just to look at the current and future merits and not look at the past merits. Because economic performance is always about the future. You can have an economy which is growing at 7% but slowing very rapidly. So would you give investments in that economy valuations based on 7% GDP growth or 5% GDP growth? You need to think through this very clearly. I would think that you need to reason out how it will look under 5% GDP growth, how assets will look, how businesses will look, how stocks will look. And based on that assessment, you need to redraw the lines of valuation which you are willing to pay. Clearly, that's a reset, right? But most people are inclined to buy based on a past performance which looks very rosy. So they would end up buying based on 7% GDP growth. Look at all the people who are owning these quality stocks. Great companies, no doubt, but bought at valuations which are vulgar, to say the least. What are they actually carrying today? They are carrying bullishness based on a short-term performance which they saw in the post-COVID recovery in all economies. They are seeing headwinds come in several industries. The rising inflation and interest rates are suddenly making the growth itself a challenge, and they have overpaid for this growth. What are they staring at? Clearly they are staring down the barrel where the valuations need to readjust downward and need to set fresh expectations based on the fears that prevail in each of their investments. Clearly, when you look at only the past, you are going to be misled into overestimating the future. The converse is also likely, that when the past is very gloomy, when things look very bad at a particular point in time, the future can only get better. There are themes that give you such opportunities, but when that opportunity is before you, you cannot rely on past performance. You need to make a objective, prospective assessment of what will happen to the company, to the industry and to valuation. In my assessment, past performance cannot give you the best future investments. At best, past performance can give you modest investment choices. So if you are one of those who wants to really become a very successful investor, learn how to use past performance constructively, where not to apply it, and how to create your own objective, prospective, forward-looking assessments of companies, sectors, industries and valuations. Thank you for watching this video.